This is account 302, lessee accounting. We're on example 2 in the lecture notes. So once again, you should have the lecture note out and in front of you. So we're going to continue with this Cougar Construction lease. And the first thing we're doing is practicing our lease classification that we just left off with. So on January 1, 2014, Cougar Construction enters into it's a 5-year non-cancelable lease. So the fact that it's non-cancelable is important. If it's cancelable, it's automatically an operating lease. The rent payment is $15,000 per year in advance. The leased item transfers ownership to the lessee at the end of the lease. So we are done there because we demonstrated it's non-cancelable and meets criterion 1, transfer of ownership. So therefore, it's a capital lease. We could, but we don't have to. We could also demonstrate that it meets the recovery of investment test. So if you took the present value of an annuity due, that's what PVA sub due means. The subscript due, 10% interest rate. That's the only interest rate we have. 5 payments, $15,000. We get $62,548, which obviously is greater than 90% of the fair value of $62,548. So we're moving on. We classified this. This is a capital lease. So if it's a capital lease, what we're required to do is calculate the capitalized amount, which we just did in the recovery of investment test. But let's go through the rules. GAAP says capitalize lower of the present value of minimum lease payments or its fair value. That's a little typo. So calculate the present value of the minimum lease payments and compare that to fair value. Now I mentioned this last time, but I'm going to emphasize it again, that this term minimum in front of the words lease payments is a specific GAAP term. And it just describes the cash flows. So the first component that it includes is the lease payment, but you have to, that's a minus sign, not a dash, subtract out executory costs. And executory costs are payments for insurance, maintenance, taxes, other things to maintain the value of the property. So you're left with the payment for use of the asset. Okay, so if you had a car lease that was $500 a month, and they told you $100 was for insurance and maintenance, $100 a month was for insurance and maintenance, you'd be left with $400 a month. Okay. So the next thing is a guaranteed residual value, and it's just the guaranteed component. If there's a residual value but it's not guaranteed, the lessee will not consider it. And once again, it doesn't have to have a guaranteed residual value, just if it's there. A bargain purchase option, if any, and renewal penalties, if any. Minimum lease payments is a specific GAAP term. Okay, when you put this word minimum in front of lease payments, this is a specific GAAP term which defines the cash flows that are to be capitalized. So once you have the cash flows, and I did the timeline again. Let me do it again. Let's say we have a 3-year lease, 0, 1, 2, 3. And if you have your lease payment minus executory costs, lease payment minus executory costs, lease payment minus executory costs, then you have bargain purchase option if it's there, renewal penalties if it's there, and what's the last one? Oh, GRV, that's we're going to work with that one the most actually. Guaranteed residual value if it's there. Okay, so these are all optional features. They don't have to be there, but if they're there, you include them as a lump sum payment at the end of the lease. All right. So which interest rate? We're going to use the lower of the lessee's incremental borrowing rate or the lessor's implicit rate, and that's if the lessee knows it. So if lessee knows it, of course the lessor always knows their rate, but the lessee may not know this rate. What's the incremental borrowing rate? It's the interest rate the lessee could get if they were going to purchase the item with financing. Okay? All right, and in our problems, we'll just be given those. In practice, finding those rates is something you would do a little workaround, but whoops. In our problems, we'll just be given those. So, after you classify, so these are capital lease steps. So, let's put step 0, classify capital lease. So if it's a capital lease, then we go to here. Lay out the minimum lease payments as cash flows on a timeline. Then select the appropriate discount rate, either the incremental borrowing rate or the implicit rate. Calculate the present value. And here's the actual capitalization. Capitalization means to recognize a long-term asset on the balance sheet. So this is the capitalization. Leased equipment held under capital lease, and the amount capitalized is the present value of the minimum lease payments. And because we are going to debit an asset, we have to credit something else, either credit another asset or, in this case, recognize a liability. And this is why it's a capital lease, because we're capitalizing a long-term asset. We are capitalizing a long-term asset. All right, capitalize leased equipment. If you would have purchased it, that's also a capitalization. Those are capital assets, long-term assets. Oh, well, that's some bad spelling there. How'd that happen? Capitalize. Okay. So, the capital lease is going to look like a finance purchase, and we mentioned that in the conceptual nature of a lease. So now let's go through the next step. After you calculate the amount that you're going to capitalize, we're going to treat it like we purchased a long-term asset, so with financing. So we're going to recognize interest expense and depreciation. So interest expense, you're going to be familiar with this because we did this with bonds. We're going to use the effective interest method. So you take the beginning of period carrying value times the effective interest rate. So interest expense equals carrying value at the beginning multiplied times the periodic effective interest rate. Okay. And then the journal entry is going to be, if it's an accrual, interest expense, interest payable. If it's on a payment date, if you had an accrual and the payment is later, you're going to pay off the payable, and part of the remainder of the payment is going to reduce the liability. But you could also have expense on the same day as the cash payment, which is a normal journal entry. So you'll have the payment, you'll calculate your interest expense, and you'll have a reduction in the principal, which is called amortization. It's not like amortizing a discount or a premium, but when you have a car loan or a mortgage, anytime you make a principal amount, it's an amortization. Okay, so this one is a normal entry. And here's a normal entry that has all components. So you might have a partial adjustment of interest expense. Part of the payment goes to a payable, and part of it goes to lease liability. And these are things that can happen in all of our accounting, not just lease accounting. If you're accounting for a mortgage or something. So all payable accounting. Okay, so let's get to an example. Oh, sorry, getting ahead of myself. Let's conceptually look at depreciation expense. Okay, so there's going to be two cases. Case one is lessee returns item at the end of the lease. And case two is leased item is expected to be transferred. So those are the two cases. Let's go back up. If the item is going to be returned at the end of the lease, the main thing is depreciate over, whoops, oh, that's not going to work, unfortunately. So evidently I can't draw in a text box. You're going to depreciate over the lease term. Okay? You're going to depreciate over the lease term. But under case 1, we have unguaranteed and guaranteed residual value. If it's going to be returned at the end of the lease, but it's unguaranteed, then we're going to depreciate all the leased equipment we capitalized. If there's a guaranteed residual value, then we're going to subtract out the amount guaranteed. I tried, but it didn't work. Sorry, guys. All right, there we go. Then you're going to subtract out the guaranteed portion of the residual value. All right, because that's what you're expecting, the lessee's expecting to return. Okay, now case 2, and if you go to the accounting standards codification, which is the authoritative GAAP literature, so I'll just put ASC, the accounting standards codification, they actually have an extensive lease section, but in this case too, they'll say, see other section, because you're going to depreciate as normal. Depreciate as normal. If the lessee is going to end up owning or expected to own the item, depreciate as normal. So it could be the case that they have a transfer of ownership. Clearly, the lessee is going to own it, depreciate as normal. Or if there's a bargain purchase option, they would almost certainly end up owning it. So you depreciate over the useful life and depreciate as normal. Or if there are excessively high renewal penalties over the useful life, such that everyone would be surprised if they didn't end up having the item over its useful life, depreciate as normal. So if there's some indication in the contract that they're going to have the item over its useful life, then it's just normal depreciation. It's not special lease depreciation. Case 1 is special lease depreciation. Case 2 is say, hey, you're going to end up having the item over its useful life, depreciate under normal depreciation rules. Okay? And then there's nothing new here in terms of the entry. You're going to have depreciation expense. Oops. Oh my goodness, it likes jumping around. You're going to have depreciation expense and accumulate depreciation. It's just how you calculate this number is changing a little bit because of the lease depreciation rules. Okay? All right, so here we finally get to example 3. And this example 3 is a no residual value example. And actually what I'm going to do here is cut the video for 1 second. This is a good time to take a break. So I'm going to restart this on example 3 for the next video.